Michael Burry, aka The Big Short, basically sold all his stock market investments. This isn't just him thinking the market's going to go down. He's actually putting his money where his mouth is. And because of that, it might pay to take notice. Has the market been deluding itself into unwarranted optimism? Are we potentially going to see the biggest crash in our lifetimes? I'm Biko Konstantinos, and that's what we're going to talk about today. Michael Burry was one of the first investors to predict and profit from the subprime mortgage crisis that occurred between 2007 and 2010. He was immortalized in the very popular movie The Big Short, where his character was played by the very popular actor Christian Bale. Now, because of his successful predictions with the subprime mortgage crisis and calling out the risks long before the crisis hit, Michael Burry has a very strong presence online, and people take very close notice to what he's saying. And lately, he's been getting very bearish on the stock market and the economy in general. Let's have a look at some of his recent bearish tweets. The silliness is back. After 1929, after 1968, after 2000, after 2008, the strain of silliness that transformed bulls into bubbles completely and utterly disappeared. But that familiar COVID-era silliness is not dead yet. Like 2001 before Enron, before 9/11, before WorldCom. Here, Burry is suggesting that the silliness that creates bubbles is currently in place, which in those examples he cited could be leading us into a future crash. On 4th of August, Nasdaq a bull market because it is 20% off its low? Who makes up this stuff? After 2000, the Nasdaq did that 7 times as it fell 78% to its 2002 low. There's a lot of commentators lately suggesting that every rally in the market means that the bottom's in and we're no longer in a bear market. But here Burry is suggesting that a typical bear market has many rallies, but that doesn't mean it's not going to end up a lot lower. And on 15th of August, contrary to the internet and the Twitter sphere, there have been bear market rallies that eclipsed 50% retracement and led to a lower low. April 1930, November 1938, June 1946, and since 1950, November 1968. Depends how you define a bear rally and or a cycle. So Burry's suggesting that even if a rally looks to make a huge percentage off its lows, depending on the time frame you use, it could still be defined as a bear market rally. These are just 3 of Burry's recent tweets he's made regarding the stock market and the economy, and you really get a sense he feels that we're deeply entrenched in a bear market, and no matter how many rallies we have, in Burry's opinion, there's a lot more downside to come. Now, there's every opinion under the sun in the markets, but you don't often see people put their money where their mouth is when it comes to their strong held beliefs. But Burry has done just that, so let's have a look what it means. Hey, before we go any further, is it pronounced Burry or Burry? I've probably been saying it totally wrong. So the way we know what he's sold is that his managed portfolio at Scion Asset Management had to lodge their 13F form, which shows all the purchases and sales that occurred during the quarter. Here's a list of all the decreases during the quarter. So we've got Apple, Bristol Myers, Booking Holdings, Discovery Communications, Alphabet, Signacorp, Meta Platforms, Ovintiv, and Nexstar Broadcasting Group. And as you can see by these second and third columns, the number of shares have gone to 0 and the value 0, which means he sold the entire positions of those stocks. Now, if we look at this list, we can see the top increases during the quarter, and the only one listed is the GEO Group, which was a purchase of $3.3 million worth. So prior to this quarter, the fund was worth about $165 million, and now it only owns one stock worth $3.3 million. This is a huge cash out, a very strong move, because nearly everyone says time in the market, you can't time the market and all that, but Burry doesn't care. It looks like he's trading on his very strong beliefs. And just reading into it, I would assume he thinks there's a lot more downside to come. And if he's right, he might make another fortune like he did in the subprime crisis. Now, I'm going to have a look at this article in Seeking Alpha, and it's written by Garrett Doik, I think it's pronounced. Man, this is hard. Lately, one of Burry's vocal concerns has been regarding consumer credit. As he points out, the monthly increase in consumer credit in June was over 40 billion, the second highest on record. March 2022 was the highest on record at 47 billion. Now, with credit increasing this fast, it's a clear sign that consumers are having difficulty maintaining their lifestyles on income alone. You can see from this chart that after the COVID lockdowns, the increase in consumer credit has surged higher, surpassing pre-COVID levels. Here we can see a chart of total consumer credit outstanding in the US, which is represented by this purple line. And as you can see, during the 50s, 60s, 70s, and 80s, outstanding credit remained very low. But fast forward into the 2000s, and it's really started to ramp up and has been surging ever since. And the increase in outstanding credit is rising a lot faster than the population growth. Looking down here, the outstanding credit amount per person has been rising and currently sits at around about $13,000. So Burry's concerned about surging credit. Are you? The article goes on to say that a combination of over-leveraged household and decreasing real personal income is a very dangerous combination for the economy. This could start weighing on consumer spending and company earnings. Business conditions are actually looking very weak. According to Garrett, the jobs market may not be as strong as it actually looks. The Empire State Manufacturing Index missed expectations by a wide margin and printed at negative 31.3, which is the lowest level since 2020 and 2009. This index is a result of a survey taken of manufacturers in and across New York State. Looking at the chart, the index is about halfway down the COVID decline and around about the same levels seen during the 2009 financial crisis. So that's not painting a very positive picture. Likewise, this chart shows us that the Empire State Manufacturing New Orders Index and the Shipments Index are both showing significant weakness. Garrett asked the question, is the stock market overpriced or underpriced? The recent bear market coincided with the decline in margin debt, which is a common occurrence in bear markets. This purple line here is margin debt, and the orange line is the S&P 500. After COVID, margin debt soared, and this in my opinion provides more evidence that we were in bubble-like territory for the stock market. But since the S&P started falling, margin debt has really dropped. Garrett explains that in a mild bear market, this could be the total of the fall, but in larger bear markets, there could be a long way to go. According to Garrett, there are two significant reasons why this could be a major bear market as opposed to just a mild one. First, we could have unexpected decline in earnings, and second, the Buffett Indicator. Now, although the earnings estimates for the S&P 500 aren't too bad at the moment, this chart shows that the US index of consumer sentiment has fallen massively, even to levels below the 2009 financial crisis. This could suggest that consumers are not actually forecasting higher earnings. The Buffett Indicator. This is a ratio of market capitalization of US publicly traded companies over US GDP. This is what the Buffett Indicator or the Wilshire 500 market cap chart looks like. If the index is below 1, then equities were considered reasonable value. We can see during the everything bubble in 2021, the index rose to 2, which basically showed that equities were overvalued and potentially in bubble-like territory. So even though the index has now fallen to around 1.5, the stock market could still be considered quite overvalued compared to the long-term mean or average. There's another very important indicator, and it's this number of subscribers here. If you can help that number rise, you may just save the planet. Now, on top of everything we've looked at, the housing market is now starting to decline. Central banks artificially inflated the market due to government intervention and cheap and easy money, but now that bubble might be starting to deflate as interest rates have had to be hiked aggressively to try to curb inflation. So if the housing market sees some significant declines, this will just add to the loss of wealth effect that people start feeling, and that combined with soaring cost of living could put a massive dampener on consumer spending, which will affect companies' earnings and potentially lead the US and the rest of the globe into a recession. So Michael Burry may not just be this fear-mongering perma bear, he might actually be a genius. I'm Biko Konstantinos.